Welcome to STO, your place to become the confident protector of the wealth you've built, earned, or inherited. Now imagine you've spent over 7 years deep in the financial markets, dedicating thousands of hours to understanding how things really work: volume, sentiment, liquidity, all the math behind price movements. Well, that's what I've done. I've tested hundreds of tools and built my own systems to find out what actually moves the needle. And today, we're diving into a story about how artificial intelligence is rewriting the rules of the stock market. It's a story about incredible power and a hidden danger that can be triggered by the smallest, most invisible glitch in the data.
So let's start with a number that's just hard to wrap your head around. $1 trillion. On the afternoon of May 6, 2010, this is roughly how much value just poof vanished from the US stock market. $1 trillion. Gone.
And get this, it happened in just 36 minutes. That's it. This event became known as the flash crash, and it absolutely stunned Wall Street. I mean, what could possibly cause that much wealth to evaporate so fast, only to pop back up a little while later? Well, it's a puzzle that points right to the automated heart of modern finance.
Now, you'd think investigators would find some massive hack, right? Or a catastrophic system meltdown. But as this researcher, Maximilian Goman, points out, the real cause was something way more subtle. It wasn't one big thing breaking down, it was a whole lot of small things reacting perfectly to bad information. And to understand how that's even possible, we need to meet the main characters in this story.
So let's talk about the algo traders. These are not the folks you see in old movies yelling in a trading pit. Nope. These are sophisticated computer programs that have kind of quietly become the most dominant force in the market today.
And just look at the scale of this thing.
Current estimates say that somewhere around 60 to 70% of all trades are executed by algorithms. Let that sink in. The majority of buying and selling decisions are being made without a human directly involved in that moment. But what are these systems, actually?
Well, an automated trading system, or ATS, is basically a program built to follow a very strict set of rules. Its whole goal is to make money by trading way faster and way more often than any human could ever dream of. Their big advantage isn't genius, it's just pure, raw speed and total obedience to their programming. Okay, so if their advantage is all about speed and obedience, how do these machines actually read the market to know when to pull the trigger? Well, they're not thinking like you and I do. Instead, they're programmed to spot patterns, mainly through a technique called trend analysis. At its very core, an algorithm is taught to see one of three basic things. Is the price generally heading up? We call that an upward trend or a bull market. Is it going down? That's a downward trend, a bear market. Or is it just bouncing around in a narrow little channel? That's a sideways or range-bound market. The machine just chews through tons of historical data to spot these simple patterns. And to see how this works, let's look at a really classic strategy called a moving average crossover. The idea is surprisingly simple. An algorithm tracks two things: the average price over a short time, like say 10 days, and the average price over a longer time, maybe 50 days. When that short-term line crosses above the long-term line, it's a signal that momentum is picking up. The algorithm's rule: buy. And when it crosses back below, you guessed it, sell. It's just math and rules executed in a blink of an eye.
And this brings us right back to that trillion-dollar mystery of the flash crash. Because when you have thousands of these super-fast rule-following systems all staring at the same data feeds, a hidden danger starts to emerge. A danger that doesn't live in the code itself, but in the data the code is reading.
Remember what the experts figured out? The cause wasn't some huge, dramatic failure you'd see in a movie. The entire system didn't just crash and go dark.
Instead, it was a chain reaction. It was a cascade of perfectly logical, automated decisions, all based on flawed information. It was this emergent disaster, born from countless independent systems, all just trying to follow their rules at the exact same time.
This shows you exactly how that domino effect played out. It all started with just one large, automated sell order. Other high-speed algorithms saw that sudden price drop, and their rules screamed, sell. This created a feedback loop. Every sale triggered more sales, which pushed prices down even faster and faster, which in turn triggered even more algorithms to sell. It was like a digital stampede with nobody holding the reins. So yeah, the flash crash was a massive wake-up call. Algorithmic trading isn't going anywhere, so the really important question became, how do we stop this from happening again? How do you build guardrails for a system that moves faster than any human can possibly react? A first gut reaction might be to just slap on a bunch of heavy, rigid regulations. But a lot of experts argue for a smarter approach. Instead of strict top-down rules, they suggest creating a market that actually rewards good behavior. We're talking about things like voluntary data certification, so companies can prove their data is clean, and mandatory stress tests to see how these algorithms react to chaotic markets before they cause a real crash.
And, these ideas aren't just for Wall Street. They fit into a much bigger picture of responsible AI principles, like the ones laid out by the UK government. The key ideas are pretty universal. Make sure there's meaningful human control somewhere in the loop. Build systems that are tough and secure. Make them transparent enough that we can actually understand what they're doing. And crucially, have clear lines of accountability when things go wrong.
Okay, so after walking through the glitch, the crazy cascade, and some of the potential solutions, what is the big takeaway here? What should you really remember from all this?
It's really this fundamental trade-off. AI gives us this incredible power and efficiency to analyze markets at a scale we could never imagine before. But that same interconnected high-speed system introduces these hidden weak spots, these hidden fragilities. The risk isn't just about a single bank failing anymore, it's about the entire ecosystem getting trapped in a death spiral because of one little piece of bad data. And this leaves us with a really critical question for the future. We are handing over more and more of the keys to our financial systems to these automated agents. They're fast, they're efficient, they're unemotional. But as we've just seen, they're only as good as the data they eat and the rules they follow. So as these machines manage more and more of our world, how do we decide where to draw the line? How much trust is too much? If you've made it this far, you're serious. And that's exactly who STOA is for. We operate on an application-only basis because we work with individuals who are ready to elevate their game. If you're tired of wasting hours chasing noise and want to implement a proven process that delivers results in less than 90 minutes a day, apply now. Seats are limited, and once they're filled, they're gone for the quarter. Click the link in the description to fill out a brief application, and if you found this valuable, please share it with another capital owner. Don't forget to like, subscribe, and leave a comment below. I look forward to connecting with you next time. Here's to your success.